You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
Well, welcome back, Brandon. I'm welcome back first. I'll let you get a word in.
How you going?
I'm going well. I've just moved into a new place, and it's been a bit of this week feels like it's gone for a long time. I'll tell you what. It's been busy.
Been a long week.
Yeah.
Well, you've had to set up everything, like new place. That's so many little things that just add up, take up your time. It's pretty annoying.
Yeah, exactly. And it's just been a lot of trips back and forth, moving stuff, and
yep.
Yeah.
Oh, getting there slowly. So you just moved. You just got a trailer and just moved your stuff, did you?
Yeah, exactly.
Wow. So that takes a while. Hey.
Yeah, it was long, and I think we're getting pretty close to being fully set up. So that'll be good. I didn't. Yeah, go on.
I was going to say it's like new YouTube space, new set, new everything.
Yeah, exactly. And I haven't made any videos this week because I've just been moving everything, but should be back next week, hopefully.
Nice. And will next week's videos be in the new set?
I'm not sure. Partial. Well, I mean, they'll be in the new place, obviously. Yeah. But in terms of what design I sort of envision, I'm not entirely sure. I've still got a couple of things to get.
All right, so I might switch around a little bit. Oh, that's exciting.
Yeah, it is certainly. It's something new, and I guess we'll kind of see how it goes and see what the feedback is on the new set design.
Will the listeners be able to get Hamish Hodder twice a week on YouTube? That is the question.
Maybe. It's unheard of.
Guys, I tried hard. I tried my hardest there for you. I'm the subscribers advocate here. I'm trying my best.
You know what? I used to do heaps.
I used to do 3 a week.
I used to do 3 a week.
Yeah.
And then I went down to 2 a week.
Yeah.
And then sometimes it's 1 a week.
Oh dear. No, I've been pretty consistent with the 2 a week. I think 2 just works for me. I mean, I don't want to do like 1 video a day like some other people do, because you end up just like talking out your butt, like just terrible garbage. Just you've got nothing really of value to add to your videos. But no, I think 2 a week's good. I mean, you can really plan them out and make sure that you are adding some sort of value with your videos. So.
Yeah, exactly. And whenever I can't if there's nothing interesting that I want to talk about, I don't sort of force myself to make a video. And I think about 2 a week, 2 a week's a good rhythm because you can typically find 2 things a week that you want to talk about.
Yeah, exactly.
Whereas I could not do 1 a day.
No way.
As some others are doing multiple a day. That's just insane. I would burn out so quick. I could probably do that for a week, I think.
Yeah.
And then you wouldn't see me for a month.
Yeah, it would be so hard. You'd need an editor, surely. If your videos were going to be any sort of quality, you'd need an editor. You'd have to be doing just the content, and then you'd have to palm it off to someone, and then someone else would have to do the editing, I reckon. There's no way I could prepare, film, edit, and upload 7 videes in a week. That would be ridiculous.
That's soul crushing.
Yeah, that would make me hate what I do.
That's the thing. I wonder. It's kind of this trade-off between wanting to see it grow, but it's like if you're not enjoying the process of it, then what's even the point? Yeah. What's even the point? Why make 7 videos a week if you're not going to enjoy it?
Yeah.
So
that's one thing that I've really thought about more over the past year or so is just whatever you do in life, just make sure that you enjoy yourself, because when you take a step back and you consider how much of your life is spent at work, I mean, it's a lot. It's really a lot of your life. So you gotta, like, if you don't do what you enjoy, then man, you're going to have some regrets later in life. I mean, you're just going to waste away. You're just going to not enjoy your life. I mean, you've only got limited time on the planet. So that's why I've made a big push into just trying to get what I like to do up to speed so that I can work on it full time. And that's obviously the YouTube channel. So,
yeah.
That's,
I mean, the good thing about what we do is that, I mean, like for this week, for example, I could have put out videos, but it would have really stressed me out managing moving everything into this new apartment, as well as coming up with some video ideas, planning, editing, and all of that. But the good thing about kind of what we do is I had the flexibility to just say, you know what, I'm just going to enjoy this. I'm going to put together some IKEA furniture this week. I'm going to go shopping this week.
You should have just live streamed yourself putting together IKEA furniture.
Yeah, I should have set up a camera and done some. Hey guys, we've taken a pivot away from.
You should have just like sat down and just gotten on a live stream and just been like, today I'm just going to talk about Thor Industries while I put together my office furniture. Just like real off the cuff, IKEA construction plus stock talk.
Oh dear, this is a 10-hour stream.
Yeah, that's the thing. Once we get going, we can't be stopped. That's why we gotta keep ourselves moving. All right, so let's move into our sponsor, and then let's get into some news topics.
Yes. So this episode, of course, is sponsored by Sharesight.
Really?
So it's a new sponsor. Actually, we've never spoken about Sharesight before, but the reason why we're talking about it is because it's so basically Sharesight's an application that I've been using basically since I started investing in order to sort of track the performance of my stock portfolio. And really it allows you to keep track of all of the different types of gains and returns or losses that you would experience as an investor. So that includes capital gains, dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you. Currency gains, if you're buying shares internationally or you hold foreign currencies. And then, of course, the main reason why I use it is when it comes to tax time. So,
it's almost tax time. It's almost tax time.
At least for some of our viewers, for the Australian and New Zealand viewers.
Yeah.
No, but so basically it'll allow you to generate up to 10 different reports that can be used at tax time to easily work out things such as capital gains, dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. And you can also use that link to get 4 months free when you sign up to a yearly subscription. So head over to sharesight.com/young investors.
And that site spelt SIGHT.
Yeah, I don't know why I didn't say it that time. I was...
Yeah, no, I'm so used to hearing you do your Sharesight thing that it just stood out immediately.
Yeah, I feel like the majority of people have heard me say that enough times that you probably know
it's just
what the spelling is.
Yeah, exactly. Baked into our brains. That's Sharesight spelled SIGHT. But no, good deal, good platform, really helpful platform, and good deal, 4 months off. That's 25% off, as we know. So get around it.
Someone's going to comment and say, Brandon, that's not 25% off.
Yeah. Well, now they won't because you just brought it up.
Maybe they will.
Maybe they still will. Who knows? Apparently, many people do not understand when we're being sarcastic, which is basically the whole podcast.
Yeah, pretty much.
But
80% sarcasm, 20%
legitimacy.
Investing.
Yeah, exactly right. We should just try and make the whole podcast sound sarcastic. No, we shouldn't do that. That would lose people real quick.
Yeah.
Did you know, Hamish, that there is a shake-up of university fees? Oh my gosh.
Really? Wow. Please explain.
Please explain. Well, this is the most important news story you have ever seen.
Yeah.
That is our first news story, because I was looking and apparently the government will announce plans to double the cost of some uni courses while slashing fees for others. So this article says that nursing degrees, maths courses and psychology courses will be slashed to just $3,700 a year in massive discounts designed to encourage younger Australians into the jobs of the future. The cost of an arts degree in communications courses is set to double to $14,500 a year as the Morrison government tries to dissuade students from studying courses without a clear job pathway. Law degrees and economics will also face fee hikes of nearly 30%, rising to $14,500.
Wow. Yeah. Now, I didn't even know that the government contributed to
I didn't know
you
either.
going to university. I was not aware that that was a thing. Of course, I was aware that there's that sort of HEX, or is it called HEX?
Yeah,
still?
help debt. Yeah,
help debt, where you basically pay nothing up front and then you kind of just pay it over the course as you
start
make
earning money
from your job. Yeah. But I did not know that they contributed in quite a substantial way as well.
What's it called? Like the Commonwealth contribution or something like that?
Yeah, something like that. Yeah. So from a very quick read that I just did, it seems that they contribute to all degrees in some manner. And this sort of news story is about how that's kind of changed. But they also provide funding placements for some students. So kind of, I guess, a bit like paying the university to provide scholarships to students through government funding. And the government's also going to be increasing this by 39,000 over the next 3 years. Right. And then basically, as a result from that, they've sort of dropped some of the contribution in some humanities courses and then increased the contribution for courses that are more likely to lead to jobs, according to the government.
I'm looking at these bands here. So this is the student contribution. So this is what the student has to pay. There's like 4 different bands. Band 1 is like teaching, psychology, English, maths, nursing, languages, and agriculture. Then band 2, so band 1, the student contribution is 3,700 per year. Then band 2, the student contribution is 7,700, which is allied health, architecture, IT, creative arts, engineering, environmental studies, and science. Band 3, you have to contribute 11,300, and that's medical, dental, and vet science. And then band 4, you have to contribute 14,500 a year, and that's law and economics, management, commerce, society and culture, humanities, communications, behavioral science. So yeah, I had no idea that that's the way it worked, but there you go. Because when I read this, I'm like, wait, the government has power to like just bump up uni degrees, and it's like, what? I don't understand how that works. But yeah, there you go. So they're actually just changing the contributions that they make to different degrees. But I mean, it makes sense. I mean, you incentivize more heavily the degrees where you need more workers. But I guess the opposite argument is that it should just be a level playing field and let people do what they want to do. But I mean, in economic terms, it's just not a great reality. I mean, if you've got a big shortfall in nurses, then obviously you need to incentivize people to become nurses and whatnot. I think that's also the way that the military does it too. Like they don't allow, for instance, if you want to go to ADFA, the Defence Force Academy, then you have to apply, and they give you a place based on what you want to become. So if there's like an intelligence position that's come open, or they need another intelligence officer, they'll try and they'll get you into ADFA in an intelligence position. So it's like you can't just go and be like, I'll just figure it out later. Like you have to apply for a certain position, I think. So it kind of works the same in that sense. Sorry, what were you going to say?
No, I was just going to say, I wonder to what degree this impacts people's decisions to pick a degree, because
true.
I don't know about you, but I didn't. I knew relatively what the price of my degree would be, but I wasn't sort of splitting hairs. I wasn't
thinking about it.
Oh, this commerce degree is actually going to be 1,600 a unit instead of 1,300. Like I just kind of looked at it and I was like, okay,
I'd rather do this.
That's what I have to pay.
Yeah.
That's it. And then, that's what I don't have to pay right now. I can just kind of not even think about that for a number of years.
Yeah. No, so you'll have to pay it back.
Well, I will now, but yeah.
But no, exactly. When you were doing the degree, you wouldn't have had to have paid it back for a while.
Yeah, exactly. And then, it comes out in a couple of percentage points at a time, unless you're making it. I think I looked at it the other day. I think if you're making over 130,000 or something, then you're starting to pay back a big chunk of it at a time.
Yeah. Because that's right. Because the more you earn, you have to pay back a larger percentage of your outstanding debt each year.
Yeah. And I think it starts at like 1% at about 45,000 or something like that.
48.
Yeah. So I don't know. I don't know what kind of impact this would have.
Yeah.
Obviously, I don't know what kind of impact it would have, but I just know that a lot of people just don't even consider the price of a degree when they go into it.
Yeah, true.
Because they don't have to pay it up front. It's not like you go out and you try and find someone to give you a loan. The loan's just kind of already there. There's no real interest on it. It's just kind of
it's just the index to inflation.
Yeah, exactly. So,
there you go.
There'll be a lot of people who kind of just continue to go into what they're interested in.
Whatever they want without really thinking about it.
Yeah.
Yeah, that makes sense. Yeah, no, I'd agree with that. I think that, because students typically don't have to pay it back for so long after they study, then they typically don't really think about what it's going to cost them. They just do whatever they want. The ones that get me are people that get like halfway through a course and then they'll be like, nah, I don't want to do this anymore. I'll do something else. They get halfway through the next course. Nah, I don't want to do this anymore. And I switch to another thing. It's like, there's got to be a certain point in time where you're just like, nah, I'm just committing. I got to get this degree. I'm getting it done.
Yeah. I mean, I've spoken to some people who are moving into a new course and they're like, yeah, and I maxed out my hex. I'm like, what? You maxed it out?
You can max out a hex debt? What the hell?
Yeah, there's a maximum number of units that you can do. So,
oh my gosh, there you go.
Wow, that's not good.
Yeah.
don't do that.
Dude, that's
Figure
not
out what
something
you
to
want.
be proud of.
Just stop for a second. Take a deep breath.
Just get a job. Stop studying. Go and make some money.
Go explore the world, figure out what you want and come back and then start taking on debt. Don't do it the other way around.
Words of wisdom. All right. What should we talk about next? You want to talk about Carnival? I found that pretty interesting.
Yeah, so Carnival reported their quarterly earnings, and sort of the headline that kind of came out of this was that they're having to sell 6 of their cruise ships.
Right. Wait, what quarter were they reporting? Just for clarification.
Q3 2025.
Oh, okay, cool. Yeah, thanks. Yeah, so anyway, so their Q3 2025 earnings came out.
Yeah, exactly. I didn't even know that you included that until you just mentioned that then, and I was like, what? That can't be right.
Got him. Anyway.
For context, Brandon just edited our notes document to include that.
Yeah.
So
it's because what were we talking about? The what was it? Zoom with the Q1
2020, 2021 or
2021. That's just bizarre. Anyway, sorry. Yeah. I won't interrupt you again. I'll let you get through the news story.
We're never going to let that go, are we? It's 2 weeks in a row. 3 weeks in a row.
It's just silly. Man, the first thing I'm going to do when I'm Prime Minister is I'm going to standardize this. All companies must report the same quarter.
Yeah. I mean, it makes sense.
It does make sense.
Don't know why it's any other way. Anyway, not important. So they're going to sell 6 cruise ships, basically out of week bookings, and then of course they reported their typical earnings. So revenue came in at $700 million, which was down 85% year over year from 4.8 billion. So certainly one of the.
How did they make any revenue? I don't even know.
That's a good point, actually. I don't know.
I just don't know.
Because revenue for Carnival is recognized when the cruises voyage. So when people actually take the cruise, rather than, of course, when the person pays for it. Because typically people pay up front. Yeah. So obviously, weird. So it means that they did do some cruising during the period, just a substantial amount.
Must have been less, yeah. Anyway, that's super weird. Yeah.
Yeah. And then in terms of net income, so in terms of profitability, they took a loss of $4.4 billion. So that's painful.
Yeah. Ouch.
700 million in revenue and then a $4.4 billion loss.
Ouch.
That's, I mean, it's not good. And I guess sort of what's interesting about this earnings is not so much those numbers. I think they were pretty expected that it was going to be horrible, but some of the other sort of interesting facts around their earnings. So one of them, of course, is that they're selling 6 of their cruise ships, which is obviously not a good sign. I mean, certainly, I guess it's kind of like if you had to sell a new car that you just bought to pay some of your bills, you're going to be selling that at a substantial loss. And particularly with the current environment, I mean, I think you mentioned this a few weeks ago, who's buying those cruise ships? I mean, it's certainly not a cruise company that's in good financial health because there aren't any. So it's going to be someone who wants to pick them up really cheap.
Yeah.
So that's going to be painful, and we'll kind of see how that plays out when they do eventually sell those cruise ships.
Here we go. Facebook cruises, Google cruises. That's what I'm tipping.
Yeah.
Google's just going to come in.
Yeah. Just drop like or 500 mil on those cruise ships.
Oh my gosh. I just set off my hey Google.
Yeah, we can't talk about Google.
No, I really can't say that word because my phone just
assistant just gets involved.
Oogle. Can I say that? I'll just say Oogle. Yeah, it doesn't respond to Oogle.
Okay.
Maybe we should invest. Maybe we should get a Young Investors podcast cruise boat.
Yeah.
That'd be pretty sweet.
That'd be a good idea.
And then all the listeners can just come on the cruise boat and we'll just do a live podcast every week.
Wow. That's just...
No, too much pressure. I couldn't do that. Man, can you imagine doing a live podcast?
What, in front of like an audience?
Yeah.
Yeah, that'd be tough. I couldn't do that.
That would be, man, I would be so nervous. I don't think I could do it.
No, I can't do podcasts in front of two people.
Oh dear.
Oh dear.
But maybe we'll see how much the cruise boats are going for, and we might make an investment. We might buy up one of the maybe a couple $100 million. We can afford that, right? How are our Sharesight referrals going?
Yeah, I was going to say, if enough of our loyal fan base join Sharesight, then we'll have no problem.
I think if every single person that ever listened to this podcast signed up for Sharesight, we might be able to afford maybe like, I don't know, part of the fence that goes around the outside of the deck.
We might be able to afford the drinks package.
Maybe the drinks package. Oh, gosh. Yeah, because those drinks packages are expensive, hey?
Dude, they are ridiculous.
They're so expensive.
About $1,000 for a 7-day cruise or something.
Yeah, I think
unlimited drinks.
I think I worked it out. Like, to make it worth your while, you have to drink like 12 standard drinks every day.
Yeah.
And like, of course, when I said that to the, people in my group, some of the guys were like, oh yeah, no worries. I'm like, yeah, okay. So sure, maybe you could smash down like 12 in a night if you were going crazy. But doing that for 7 days straight, that's not good.
Yeah. And the thing is, that calculation means that if you didn't buy the drinks package and you drank like 12 standard drinks a day, you would be in the same situation as if you got the unlimited. So
yeah.
It's almost like which one do you want to bet on? That you're definitely going to drink more than 12 standard drinks a day, which you could do, but you wouldn't remember the cruise. So.
Yeah, exactly right. Yeah. And if you happen to if you don't get a drinks package and you happen on one day to decide not to drink, then you're just saving money.
Yeah, exactly right.
Anyway.
Young investors' advice.
Yeah,
don't get the drinks package.
Don't get the drinks package. We obviously don't hold any shares in any of these cruise companies. Other people are like, make sure you get the drinks package, guys.
Yeah, I was about to say if I buy Carnival cruise stock next week, we're just like, so let's talk about all of the different cruises that Carnival has available. Do you want to go to the Bahamas?
It's a great cruise line, and we are exclusively going to offer our podcast to people that book with Carnival Cruise Line. No. Sorry, what we were even talking about? What was it? Their earnings. Do we have anything else for their earnings?
Yeah. So one other interesting thing that I saw was that so basically through this period, of course, there's been a number of passengers or customers, I should say, who paid deposits in advance who could then not go on the cruise. So they had to get some kind of refund. And of course, Carnival being in similar position to the other cruise companies where they had quite a lot of debt and they really couldn't afford to provide a lot of cash refunds, they were trying to incentivize people to take some kind of credit. So so that they could book next year or something like that and get a huge discount on a cruise or whatever. Yeah. And we've kind of seen a little bit of an outcome of their efforts there. And basically the management team reported that half of the guests affected by the shutdown so far this year have requested cash refunds. So that's quite a lot, I think. I remember, I don't know the numbers off the top of my head now, but I remember looking and seeing if they had to refund all of them, they would have, and this basically applied for all of the major cruise liners, the major three ones. If they had to refund all of their deposits as cash, they would have been screwed, all of them. So half certainly means that they're still in a tricky position, but they've been kind of been able to balance that with some capital raising. So they raised $6.6 billion this year so far, partially in bonds, partially in debt. And then they've also been issuing shares, so diluting the shares in order to raise some more capital. And then also, of course, now they're saying that they're going to have to sell some of their cruise ships, which would not only mean that they take a loss on those investments in cruise ships, but it also means that their ability to generate revenue is diminished, right? Because they'll have 6 less cruise ships that might have 1,000 people that go on them. Some of Carnival's cruise ships are huge, 1,000, 2,000 people, and they won't be able to do voyages until they buy them back, or they, I don't know, whatever kind of deal they do, they build new ones or whatever.
They're going to have to run the least amount of ships possible and pack them out as much as that, like get as 100% occupancy on every single cruise, I reckon.
Yeah.
They're just going to have to try and make the economics work because, that's rough. But yeah, you're exactly right. If they were running at pretty good occupancy before and then now they're having 6 cruise ships less, then obviously they're going to have much fewer customers. So anyway, pretty crazy. I mean, man, I just would not like to be tied up in the cruise line industry at the moment.
Oh, not at all. I mean, the stock's down 63% year to date.
Yeah, and just uncertainty.
Yeah. It has rallied. If you go from bottom to where it is now, I think it's up about 130%. And it's funny, as soon as that happens, you see all the comments, just people being like,
of course.
Here it comes.
Yeah. From the bottom to, wow, you're right, 136%. But to be honest, I would not like. I mean, it's just gambling, isn't it? If you dumping money into cruise line stocks, I mean, you're just putting your money on the line and crossing your fingers and saying, hope it pulls through.
Yeah, I mean, you made a video earlier this week, I think, talking about the sort of 3 major pillars of a great business.
Yeah.
And they might meet some of those requirements. I mean, you could argue that they have some kind of competitive advantage because they're the biggest in the industry. And I mean, a lot of people, they typically only go on a sort of, I mean, for most people, I think, go on 1 or 2 cruises throughout their lifetime. But when they do go on a cruise, they've gone with one brand. And if the experience is good, then they'll tell all of their friends and family, and that's usually sort of good business for these companies.
Yeah, but it's all up in the air at the moment. Hey.
Yeah, it's. I mean, in terms of management, they're certainly not in a position where they have a good financial position. I guess is kind of where the risk comes from.
Debt management is questionable at best.
Yeah.
Anyway, we'll leave that one there. Let's move on. I got this interesting story that just caught my eye. Bauer Media, they've just decided to sell. So they own a lot of Australian magazines, I think, like New Idea and Women's Weekly and that sort of stuff. But what caught my eye is that they bought all these magazine titles 8 years ago for $525 million, and now they're getting rid of them today for under $50 million. How's that for a loss? Yeah.
Ouch.
Yeah, I'll read what the article says. German publishing giant Bauer Media will make a spectacular exit from Australia after 8 turbulent years, offloading its local magazine division to a private equity firm. A deal was struck last night for Mercury Capital to acquire the portfolio of magazines, including iconic titles The Women's Weekly, New Idea, and Woman's Day. It's understood on again, off again negotiations have been underway for several months. Bauer entered the market in 2012 with a mammoth purchase of ACP Magazines, formerly owned by the Packer family, for $525 million. The AFR reports that the Mercury deal is worth less than $50 million. It's pretty insane.
Who's buying a magazine?
That's exactly what I was going to bring up. Who
in
is
2012?
buying? Magazines are done. Like, I don't understand who as a business person can look at the magazine industry and say, oh yeah, here we go. Like this is the way to make money. Magazines are cooked. They are just not. Who buys magazines? Who reads magazines?
I have to read what you've written here in the document. Brandon's just written a line here. Yeah. Magazines are just shit.
They're just terrible. They're so bad. I mean, in the age of the internet, who is still interested in buying and distributing magazines? Like, I don't know. I don't get it. Am I crazy? Maybe. I don't know.
No, I mean, I don't know. I mean, we're both pretty young. So I think, I mean, even I guess relating this to sort of newspapers as well, that's never been something that I grew up with, I guess.
Yeah.
I mean, maybe when I was really young, but then I wasn't reading newspapers. So there was no sort of time where I was reading articles physically. I felt like the majority of the time it's just been online, and that's just been my experience. And I don't know why you would ever go back, or what is the benefit of a physical
I guess maybe
magazine?
There's still some businesses that need to target that specific demographic that buys these kind of magazines. But just in general, I'm thinking like, okay, if I run a business and I want to advertise, I want to target a very specific demographic that, you know, that I know is what my business targets. For me and my business, I know it's generally males between 25 and kind of 35 with interests of stock market investing, money, wealth, you know, yada, yada. I mean, even if your business is like plumbing or something, you got to think about, okay, well, where do I want to advertise? You look at all these different advertising options, and you've got things like television ads, or radio ads, or magazine ads, or Facebook, where, you know, as an example, Facebook, where you can target people that, you know, have been or Google, where people have been searching best plumber Melbourne or something like that.
Yeah.
And you can specifically target your ads towards those people. Whereas if you're like running a radio ad, you're just broadcasting to the world, hey, do you by chance need your toilet unblocked? Like, give me a call.
Or like a billboard.
Yeah, billboard. It's just like those really non-specific advertising, broadcasting advertising ways. They're just so, I don't know. I'm just not a fan.
No, and that's even just one dimension of it, is that the targeting is way better for digital advertising through Google or Facebook. The other dimension is that it's cheaper.
The cost.
It's just cheaper for the number of people that
you can
see
reach
your ad. So not only do more people see your ad per dollar that you're spending if you advertise online, you're targeting people specifically that would be interested, whether it's people searching for, I need a plumber, or plumbers in my local area, and people can just target, okay, I'm a plumber in, I don't know, Southeast Melbourne or whatever it is, and I'm just going to target people who are in Southeast Melbourne who are searching for plumbers. It's as specific as you can get.
It's like, I know that for Profitful, I can get someone to follow my business for 15 cents.
Right.
That's like, just from the very minimal advertising experience that I've got, I know that if I want to, I can run ads and it'll cost me about 15 cents to get someone to follow my business.
Oh, right. So that's how your YouTube channel's growing so fast, Brett.
Yeah.
This truth comes out.
There we go. How many, I'll figure out how much would I have had to have paid. Sorry, you keep talking.
No, it's the other thing to talk about as well, I guess, in relation to this is just with, I guess, what we do on YouTube. It's nice to also, I mean, of course, digital advertising is substantially cheaper than other kinds of advertising, but it's also nice to be on the other side where we are also, we have the sort of opportunity to sell advertising space, whether we're advertising our own products or other people's products. To have an audience online now is so valuable,
very powerful.
Particularly if you kind of have if you talk about a very specific kind of topic, like we kind of focus in on finance, particularly investing. You have people who are very interested in sort of paying for that advertising space. YouTube pays us a little bit, and then sort of
if you have
the occasional
sponsor
brand
or
deal. Yeah. Like Sharesight. Go check them
out. That's the thing. A lot of people get annoyed when YouTubers accept like sponsorship deals. But at the end of the day, like I really don't understand it, because very commonly it ends in all parties benefiting. because you're partnering with someone. Well, obviously for like people like us that actually have some respect for our audience, we only partner with people or brands that are offering products that are actually genuinely beneficial to other people. They're not just like scams. So there's the fact, and then there's also the fact that we get support with what we do. The company obviously gets more customers, but very commonly, like what we've got with Sharesight, the consumer gets some sort of really good deal.
Yeah.
It's like a win-win-win if you look at it. But
yeah, it really bothers me when I see people making brand deals with the same, or affiliate deals with the same companies just because it's kind of consensus that they offer the best commissions. That kind of bothers me. And I see a lot of people doing that. It's not which of these products do I use, or services that do I use that is actually really good. It's okay, let's look up and find the biggest commission stockbroker site, and I'm going to say that I use that now.
So true.
I think that's what bothers people. It bothers me certainly when I see that. I mean, I think I did a very short promo for Stake, but since then I've only done a deal with Sharesight. Because it's one of the only services I just don't use that many services. I use that service and maybe a couple others that I might reach out to at some point, but besides that.
No, I'm the exact same. Like I get like spammed with so many emails from just like, cryptocurrencyexchange.com, or just like garbage like this. And I'm just like, no. I've only had I've had one real sponsor, which has been Stake. And the only reason that I partner with them is because I literally use their platform. Like when I'm trading, when I'm investing in US stocks, I'm investing through Stake. It's like I've been people from like Webull and what are some of those other ones? eToro, those kind of ones.
M1 Finance. There's a small group of like three or four. They all reach out, but
at the end of the day, like I don't use Webull, I don't use eToro, I don't use Plus 500. So to me, like personally, I just feel terrible if I was just like, hey, everyone, go sign up for this service. But by the way, I don't use it. But if you sign up, I'm going to get a lot of money. So it feels so bad. I don't know. I would feel so bad if I did that. But maybe other people don't. Maybe. I don't know. Anyway, what were we even talking about? Good question. Magazines. That's right. Magazines are toast. Moving on. What have we got next? You want to talk about Ray Dalio?
Yeah, so Ray Dalio has come out and said a couple more things. He's been quite vocal, actually.
I love that guy.
Yeah, it's kind of interesting because he said that he was going to, for a while now, he's been saying that he's kind of getting his sort of last bit of education out before he goes into what he calls his sort of, I guess, retirement phase of life where he's not going to be public anymore. He's just going to go away and I don't know what he's going to do, meditate or something. Yeah, just be rich. Just count his billions. Yeah. No, but he said another thing recently. Basically, he said that globalization, which has been, he says, perhaps the largest driver of developed world profitability over the past few decades, has peaked. And as a result of that, he thinks that investors could be facing a, quote, lost decade over the next 10 years.
Jeez, that doesn't sound very good.
Yeah, it sounds pretty grim, right? And I mean, what he means by a lost decade is basically we could see a stock market that goes nowhere for a decade. And a lot of people might think sort of, how can that happen? How could there be a period where for an entire decade, the stock market goes nowhere? And basically he was explaining that even if profits return to pre-COVID levels, so even if profits go back, the virus goes away, we get a vaccine, everyone goes back to spending as much money as they were in the economy before COVID, if valuations come down to historical averages, then the stock prices of businesses can remain flat or decrease over the next decade, basically. So it's basically just, I mean, we talk about this quite a lot, and this kind of relates again to what you were talking about in your video earlier this week. Sorry to plug you so much.
Oh, no, that's all right. You go for it.
But you were talking, I think, what was the title? It's something about your 10 favorite stocks or 10 favorite businesses or something.
What was that? The one, what was I talking about? Oh, I've been talking about like my most recent video is talking about some. Well, I ended up focusing on Facebook as one of my stocks that I really like. The one before that was I was talking about the idea of people wanting to sell now, take their profits, clear their profits off the table.
Got it. Right.
Is that one where I was talking about general market valuation?
Yeah, and you were talking about how it's not just enough to buy a great business. You have to consider the price that you're paying for that business.
I think I say that in basically every single video.
yeah. It's probably I'm not sure which one I watched, but you certainly said that.
I guess they'll just have to watch the last 10 videos that I've made.
Yeah, just pick one. Just kind of roll a dice.
You got to watch all of them.
No,
and leave a like and subscribe.
Then they won't have time to watch my videos, okay?
Right. Your one video.
My no videos out this week.
Oh dear. Anyway, sorry.
I can't even remember what I was talking about. Something about
talking about buying businesses when they're fairly priced and how the market's expensive.
Yeah, I guess the overall point here is that even if profits go up for businesses, if their valuations come back, which, I mean, they're already at very high levels compared to historical averages. So if they come back to historical averages, and what we mean by valuation is the price of a business compared to its earnings, its current earnings, that's currently at a really, I don't know where it is in terms of the S&P Schiller PE or anything like that. But
30 times earnings, I think.
Yeah, so it's at about 30 times earnings. The historical average is about 15.
Yeah,
so
16, yeah.
Just in that, even if profits doubled, if valuations went back to the historical average, then you have a stock price, a stock market that goes nowhere over a decade. And you could certainly see a period where profits go up double over a 10-year period. That's happened. That's kind of a fairly fair expectation.
Yeah, for sure.
And it's also a fair expectation that we could see valuations go back to historical averages. And that's kind of what Dalio is talking about. And it just highlights the importance of not just picking great businesses, but considering the price that you're paying for those businesses, figuring out what are you actually going to get out of that business in the future and running through those calculations. Because there's a lot of good businesses that their prices they've just priced in all of their future potential in a way that their profits might go up, but their valuation will slowly come down as their potential to grow over time kind of diminishes.
I reckon that's a pretty good video idea. Where'd you hear the Ray Dalio thing? Is this like an interview he did, or is this one of his papers that he released?
It was just an article that I read. I presume it's probably an article. I should have read this, but it was probably an article taken from one of his LinkedIn posts.
Yeah, he does so many of those good, really in-depth LinkedIn posts. Yeah.
Yeah, they're fantastic. If you haven't seen any of those, go check out his LinkedIn because he does these, they're like essays really.
Yeah, they really are. Yeah.
Yeah.
He's so smart.
Yeah, it's kind of like a chapter out of a book each time. And on top of that, he refers back to some of his other publications that he's done, such as the Big Debt Cycles. I think that's what it was called, the Big Debt Crises, maybe?
Yeah, Principles for Navigating Big Debt Crises or something like that.
Yeah, that's I haven't read all of it. It's huge. But basically, he goes through and explains every single debt crisis that has happened, every kind of major recession that's happened over the past, 100 years or something like that. And I think he released that for free. I don't think you have to pay for that.
You can get it like online PDF. Yeah.
So
it's free read. Yeah.
He posts a lot of good stuff. And you certainly don't want to just listen to him and believe everything that he says, but it's always good to get the opinion of someone who is obviously very involved in this stuff, and he runs the biggest hedge fund. He manages the most money in the world. Wow. Well, he doesn't anymore, but the company that he built Bridgewater does. So he's certainly someone you want to look to get some opinions about where you think the markets will go in the future. And I think it's good advice to consider the price that you pay for an investment.
Just maybe.
You wouldn't know it if you just if you picked a random video in the finance community on YouTube.
So sad, you really wouldn't know it. You'd literally just think that stock market investing is just gambling.
Yeah.
So sad. Anyway, let's go. Oh, here's this crazy thing, right? So bankrupt car giant Hertz wins approval to offer potentially worthless shares. How's that for a headline? So check this, right? So Hertz won court approval for its plan to raise cash by selling new shares that the bankrupt car rental company concedes could end up being worthless. Judge Mary Walrath ruled during a bankruptcy court hearing that Hertz can go ahead with the offering, which the company has said could bring in as much as $1 billion US. It's seeking to take advantage of the recent improbable rally in its shares to help resolve the massive debts that forced it into bankruptcy. Wow. Hertz based its request to the court on a nearly tenfold increase in its stock from 56 cents on May the 26th to $5.53 on Monday. So the stock has slid since then, closing at $2.83. But man, that is crazy. So bankruptcy experts have said the Hertz plan is unusual and possibly unprecedented, with shareholders likely to be wiped out because creditors must be repaid in full before the equity investors get anything. So let me get this right. Hertz is going bankrupt. They want to try, in a last-ditch effort to avoid going completely bust, they want to try and raise $1 billion from new investors. And they themselves have conceded that if you were to invest in this equity raise, your shares may very well end up being worth zero.
Yeah. Yeah, I mean, my understanding is that there's debts they can't pay, which is why they're in bankruptcy court.
Yeah.
They're going to try and raise some capital. So if you buy those shares, they'll raise some capital, but if they don't raise enough, it'll all go to the creditors and the company will still go bankrupt.
Because when the company goes bankrupt, all of the lenders get paid back first, right?
Correct, yeah.
And then if there's anything left over, then it goes to the shareholders.
Yeah, exactly. So I don't know what's more shocking, the fact that they're allowed to do this or the fact that the stock rallied tenfold in a month, even though they're in bankruptcy court. That's kind of scary.
Wow. That's probably, do you reckon there's ever been, I just don't know stock market history well enough, but do you reckon there's ever been a situation where a company's been in bankruptcy court and their stock price has gone up 10x?
I mean, I don't know.
I mean, maybe stranger things have happened, but that just seems so damn improbable.
Yeah, it's don't do it. I just know there's so many people who are like, oh boy, this could go 100x. If it went 10x in a month, what could it do in a year? What could it do in 10 years? You just know there's someone out there just sitting on their Robinhood account or something.
Oh, it's so true. It's so true. Anyway, but
yeah.
But the scary thing is that there might be people that will be willing to chance $1 billion on Hertz not going bankrupt. I just like if you're an investor, like an investor, then surely you just...
This is the best investment of all time, of course.
No, Hamish, no. Don't even say that. Remember what I said about sarcasm, Hamish?
Sorry.
But seriously, I don't know. I mean, I would rather put my money, my $1 billion, into an extremely overvalued yet stable company than a company that is potentially facing bankruptcy where my $1 billion could be wiped to zero.
That is true. Yeah.
I don't know. Maybe I'm crazy.
Maybe you are crazy.
Maybe I probably am crazy. Anyway, not too much to say about that one. Should we move on and do some Q&A questions?
Yeah,
maybe?
Let's do some Q&A.
All right,
see what we got.
Hit me.
All right. So I'll answer this. I'll ask this one to you, Brandon.
Sure.
What is the best way to calculate when to sell a stock, I presume? Maybe they're talking about sell anything.
Maybe.
How do you know?
You probably apply the same general principles. Well, I
That's
mean,
true.
When you sell, like there's no concrete yet. Like you should sell here, you shouldn't sell here. I mean, what I say when I'm investing, and I've said this in a video recently, is there's kind of two categories where I'd consider selling. If I'm invested in a company that was wonderful and I really, really liked it and I got in and, I've been holding it, and then all of a sudden the management team's changing for the worse, or that they're losing their competitive advantage. For some reason, the company's just not a great company anymore, then I will definitely consider selling, because at the end of the day, I just don't want to hold businesses that aren't high quality. So that's kind of the first criteria. The second criteria that I say for selling is when the stock price is really overvalued. And I did talk about this in a recent video. This is completely individual. Like, if you're in a high quality business, you could be someone that will sell it when it's maybe, 20% overvalued. You just say, nah, this is getting too expensive for me. I'm going to take my profits. Or you might be someone that sells if it's 100% overvalued, if it's double the fair value that you've calculated. You might be someone that says, I'm getting out then. Or you could be someone like Warren Buffett, where he plans on holding his stocks for decades. So even if the stock goes really overvalued, as long as the business is still high quality, then he'll just hold. He doesn't really consider selling, because his favorite holding period is forever. That's one of his quotes that he says. And the fact of the matter is that this is just different to each individual. Like, you could also say that Warren Buffett's, he's got so much money, it doesn't really matter. He can just keep holding. Whereas for us, we're little guys. We want to snowball our money a little bit quicker. So maybe we do want to sell when it's really overvalued, try and find some better opportunities and ride them up and sell and snowball our money. We'll try and snowball it quicker, but it's totally individual. But what do you think?
Yeah, I mean, I certainly agree with everything you just said there.
Yeah.
I probably lean more on in terms of selling for whether it's overvalued. I certainly think I lean more towards the Warren Buffett side. Yeah, the hold over the long term compared to trying to trade in and out of businesses all the time. Yeah. One other thing that I will add to, as for a reason why you might want to sell, is not only if it's overvalued, if there is a substantially better opportunity and you don't have cash that you can move into that opportunity. So if you don't have cash around and there's a business that's offering you, based on your calculation, maybe a 15% return, and then one of the other ones in your portfolio has gone up a ton, so it's offering you a 5 or 6% long-term return.
That's a good point.
Then that might be a reason why you would want to sell some of that. But typically, in an ideal world, the kind of the philosophy that I follow is that you want to find businesses that you could hold forever. And of course, most of the time that's not the case. Like you said, management changes, competitive advantages change, or the business itself moves into a new market that you don't understand, or it gets too expensive. But in an ideal world, you're looking to be very patient in finding businesses that you can hopefully hold for a very long time.
Yeah. Yeah, no, I agree. That's a really good point, actually, that you bring up. All right, let's move on to this next one. Oh, here's a tough one. If you had to choose, would you invest in the S&P 500 or would you invest in Berkshire Hathaway?
The S&P 500. I think Buffett even came out and said that it's likely that they'll underperform the S&P 500 in the future. Yeah.
I could probably understand that, because Warren Buffett's built that, but he's built Berkshire Hathaway to be based on very traditional businesses. Whereas you could probably argue that a lot of the advances in technology and the advances in the stock market over the next maybe 10, 20, 30 years are going to be in those really higher growth, digital-based companies that Warren Buffett simply just doesn't look at. So that's actually a really good point. I'd probably agree. I'd probably just own the S&P 500. To be honest, a lot of the stuff that Berkshire Hathaway invests in is kind of not really interesting to me. So in all honesty, I probably find it pretty difficult just to keep up with Berkshire Hathaway.
Yeah, I mean, my view on this is if I'm investing in anything that's sort of a broad if you're investing in Berkshire Hathaway, you're essentially investing in a fund, right? They have a ton of different companies that they either own wholly or partly. And if you're investing if I was looking to invest in something like that, something really highly diversified, then I just want to go completely diversified. So either the entire US market or the entire Australian market, or even maybe some kind of global makeup, which would probably be 40% US anyway. But something that gives you complete diversity. And we have a lot of data going back for the S&P 500. So that's where I would go.
Yeah, no, I'd agree. All right, let's wrap it up. Thanks always for sending in your questions, man. We've got such a backlog. Oh,
Yeah.
we'll probably, maybe next week, do you want to try and maybe keep the podcast maybe a bit shorter and we'll just smash through some more Q&A questions potentially?
Yeah, that'd be good. We could do it.
Or maybe we could do like a
chunk.
Q&A episode or something like that. I don't know. Maybe if nothing much is happening in the markets, we'll do Q&A or something like that.
Yeah, that sounds good.
We'll see. Because we need to play. We're playing catch up now.
Yeah, exactly.
But that's all good. I mean, we super appreciate you guys sending in all the questions. We really enjoy the interaction and you guys asking away, and we like discussing kind of what's on your mind in the podcast. So we always like doing the Q&A stuff. But yeah, I think we'll wrap things up there. That's about an hour. Thanks, Hamish, for joining me, taking time out of your very busy week. To come and talk to an old fart like myself. He says, as a 25-year-old.
Yeah.
Well, I'm old compared to you. You're 22. Is that right? Yeah, that is right, isn't it?
That is right.
22. Yeah. But there we go. No, thanks very much, guys, for listening. Thanks, Hamish, for joining me as always. And thanks to Sharesight for sponsoring the podcast as always. And we'll talk to you guys next week.
See you later, guys.